Sensex was sitting at 85,571 points in September last year. Well, today, in February, the Indian Sensex has fallen by more than 10,000 points. The rupee was at $83.56 in September last year. And today, you all know the story. It's already sitting at 86.86. And this happened after it touched almost 88 to a dollar almost 48 hours ago. Now, Indian investors have collectively lost almost 60 lakh crore rupees since September of 2024. You might be wondering, what are the prime reasons? Well, there are many, but we have collated 5 for you. It's a combination of global and Indian factors, ladies and gentlemen. Hello, my name is Abhinav Trivedi and you're watching Mint Explains. The first reason is high valuations. Now, India Inc. is suffering from high valuations and low earnings. Global and domestic investors have been complaining about expensive valuations in the Indian market. Recently, valuations grew. Ashwath Damodaran in a blog post wrote that the most expensive market in the world is India. And no amount of hand-waving about the India story can justify paying 31 times the earnings, 3 times the revenue and 20 times the EBITDA in the aggregate for Indian companies. Now, despite having a relatively fast-growing economy, its current valuations are far above those of the other markets globally. Now, this is the situation. Now, earnings of all the major companies has been suboptimal in the past few quarters or below market expectations. This has impacted the sentiment. Now, low earnings by the companies indicates less consumer spending and less money in the hands of people because of high taxes, low salaries and high unemployment. In the recent budget, the finance minister did try to address this issue through income tax relief, where all of us were gung-ho. Most of the high-profile startups are relying on IPOs to raise money because VCs are not putting any more money. They're cautious. Bottom line is, high valuations has been causing investors to avoid the Indian equities market and bet on other markets. Like whom? China, Latin America, Eastern Europe. The next in line is foreign portfolio investors deserting India. Now, foreign portfolio investors sold 1,20,598.42 crores in the secondary markets in 2024, according to the data by NSDL. In 2024, these investors had withdrawn 1,50,250 crore rupees from Indian equities, almost. In 2023, they were net buyers worth 1,32,648 crores, the highest ever in the past 10 years. Now, not only that, in 2025 alone, where we had not even touched 60 days, FPIs have withdrawn 85,300 crores worth of money. Now, most of the withdrawals have been due to better return generation in other markets, but also high valuation of Indian equities, as we mentioned earlier. The next in the list is, of course, weak Indian economy. Now, you might hear or say anything on the internet, but a weaker manufacturing sector and slower corporate investments are seen dragging India's growth to 6.4% in 24-25, which is the slowest pace in 4 years. Private investment is seen rising by 6.4% in 24-25, lower than 9% growth in the previous year. While consumption, which accounts for nearly 58% of the GDP, is estimated to expand by 7.3% compared to 4% in the previous fiscal year. Add high retail inflation, high unemployment and low salary or wage growth and you see the big picture, ladies and gentlemen. The RBI had in December revised its GDP growth forecast to 6.6% from 7.2% earlier. In the last monetary policy meeting on February 7th, the central bank projected real GDP growth for 25-26 at 6.7%. Now that has been low, ladies and gentlemen. Next on the list is, of course, rupee and dollar equation. Let's be clear. FPI withdrawal has severely battered the Indian currency. One of the biggest effects of such withdrawals is, of course, the effect on currency. But the rupee has fallen by 3.6% since September. But that's not the only currency which has fallen. Japanese yen, Canadian dollar, British pound, Australian dollar, euro. Every currency has been falling because the dollar has been going up. Also, one more fact. the Indian currency is performing better against the dollar compared to the South Korean won, which depreciated 9.83%, and New Zealand dollar depreciated 10.97%. The US dollar index has appreciated by more than 3% since November 2024, almost equivalent to rupee's fall, a timeline which is synonymous to Donald Trump becoming the US president. Next reason, of course, is one man, Donald Trump and his uncertainties. Now, the US president's high focus on enhancing the dollar, trade war, tariffs, and stand on various policies from climate change to China has rattled the global markets. Many investors had built positions assuming that Trump's policies would keep the dollar strong and push US bonds higher. However, as fears of a global economic slowdown grow, demand for US Treasury bonds has surged, driving yields lower and boosting bond prices, US bond prices. This has led to unwinding of trades that had anticipating rising yields, catching investors across the globe off guard. We spoke to a bunch of economists, and this is what they had to say about the falling Sensex.
There are essentially four reasons that I can think of which would explain the decline of the Sensex since September. The first is, of course, the overarching factor of the Indian market being overvalued, which means that the stocks have been extremely pricey compared to other markets and also in absolute terms. Then we had news of a revival in China, which earlier was a bit in the dumps, and the revival pulled money out of this overvalued Indian market into the Chinese market, which was extremely cheap. Then came some of the macro as well as the company earnings numbers for the second quarter of fiscal year 24, that is 24-25, and that was weak. This was followed by the flip-flop on the Fed's decision to cut rates. Initially, the expectation was that the rate cuts would be fairly deep, but given the continued traction in the US economy and enduring inflation, these expectations were revised. This was also a factor that affected the Indian markets. And finally, you now have the Trump phenomena, which is largely the issue of tariffs, which is going to affect global trade and global growth.
Globally, we have seen Ukraine war still pan out. It's not over yet. The rising geopolitical tensions, including the Middle East conflicts. What have they done is push up the oil price and increasing India's import bill. At the same time, the higher interest rates in the US has actually led to the foreign investors to move their money out of the Indian market, for the simple fact that the US fixed returns is seen as a less riskier and more attractive than emerging market returns, which has emerging market risk as well. And domestically, we have seen the volatility of the Indian rupee, have very high inflation that we've been struggling with the last couple of months, as well as the economic narrative being slower than what it had been the last couple of years. In addition, we've also seen weaker corporate earnings. These have all affected investor confidence. And if you add the political uncertainty that we saw in the run-up to the national elections last year and the run-up to the state elections last year, these have also made the markets jittery at times. And more importantly, the Indian stocks are one of the most expensive stocks in the world.
It's been touted that one of the major reasons for this decline is an exit of capital of nearly $23 billion of international foreign institutional investors away from the Indian equity market. And one of the major reasons driving this flight of capital seems to be the poor performance of the Indian economy, where, because the growth rate is declining from, say, 8%, which the FIIs are used to 6 to 6.5% now, there's a flight of capital. However, in my view, there's a very different reason driving these trends. And what I see is that FIIs are actually waiting to see the full extent of the Trump tariffs and also the kind of economic reforms that the president would bring in before deciding which is the most promising emerging economy to favor.
So these are the top reasons why you are losing money in the Sensex, why everything is in red. This phase will likely continue for some time.